in 3, 2, 1. Hello, and welcome to the third episode of the Market Pulse series. Today, it's a big day. We'll be focusing on the S&P 500. So we'll be looking at how to actually trade it. We'll be looking at the different specifications of the particular asset. We'll be looking at where to get information about trading the S&P 500, what moves the S&P 500, and right after that, we'll look at the technical analysis and also potential outlook of how the S&P 500 might perform over the next couple of months towards next year. So with me, I have Samson Zera, financial markets consultant at FX Pesa, and my name is Rufas Kamau, market analyst at FX Pesa. So before we make any progress, I would like to begin by a mic test. So if you can hear me clearly, kindly type hi on the live comment section, and this will confirm that everything is working just fine. Thank you for your response. Hello, Hasoking, joining from Kisumu. Welcome to the session. Hello, Joseph. Hi, welcome to the session. Thank you guys for your awesome responses. Kipkirui, hi, welcome to the session. So, as I already mentioned, today we'll be focusing on the S&P 500. So, from the chart, what you can see right here is the chart of S&P 500. So, on the FX Pesa platform, this particular asset is labeled as a US 500. So when you're doing your analysis, you might realize that there's different names for the particular asset, but all the more it represents the same exact thing. So to begin with, what is the S&P 500 index? So this is basically an index that is basically built by combining the average performance of the top 500 companies in the US into one index, basically tracking the performance of the entire stock market. So it's basically referred to as the benchmark index. So it's basically used to measure or estimate the performance of the S&P 500, and you can estimate these over a period of time. That is, you can do over a year. You can do over a small period of time, let's say daily performance, 1 hour performance, and so on. So when it comes to the formation of the S&P 500, it's pretty simple. So I'll be trying to share a very simple illustration, very oversimplified. So hope you can see the white screen. So since we are focusing on the US equities, if you take company number 1 or the biggest company in the US, and then you take its stock price, then you add that to company number 2 in the US. You do this to company number 3, and then you do this, and you keep adding up until you get to the 500 biggest company in the US. Then you divide the total by 500. You'll get one oversimplified index that you can describe as the S&P 500. However, when we are calculating the value of an index, we realize that most companies are not the same. They don't have the same level of performance, and also they don't have the same level of size or market capitalization. So you will realize that when the S&P 500 index is being calculated, it doesn't consider all the 500 companies the same way. So different companies will have different weights. So one company will have a bigger weight in the index, whereas another company would have a smaller weight in the index. So bottom line, all the 500 top companies in the US are combined into one index that basically displays the overall performance of the entire stock market. So if generally all the 500 companies are doing well, then the index is going up. If they are doing badly, then the index tends to go down. So at the same time, of course, not all the companies will be performing the same at all times. So in some cases, you realize that this particular company is performing better than that other company. So most of the time, there will be mixed reactions between different companies or mixed performances. So let's take a look at the S&P 500 as it performs today or even for the entire year. So I'm going to use a very popular website called FinViz, or Financial Visualizations. So I'm going to take a key interest in the maps section here. So the graphic that you see right in front of you basically represents all the 500 companies in the S&P. So as you can see, some of them are represented by a bigger square or rectangle, while others are represented by a smaller square. So an example, if you look at Adobe right here, it's a smaller square. If you look at Oracle, it's small, and then Microsoft is bigger. So when I mentioned about weights, then it's very clear from this illustration that Microsoft has a much bigger weight in the S&P 500 compared to other companies. So
yeah, I think Rufas,
yes,
before you proceed, there's one thing that you should clearly highlight, and that is the importance of the S&P index in general. The first things first is that we have a lot of money managers, especially in the US. And one thing that they're trying to do is beat whatever if someone comes and invests generally in the S&P as opposed to getting into one money manager, are they able to beat this index? Because this index comprises of all the major companies divided amongst themselves in terms of market capitalization. So it's a very crucial index in the US in terms of diversification. Yeah. So are money managers able to beat this index by allocating their shares in the most optimal way? So in this case, the index is one of the most followed indices in the US or in the globe, because it has this diversified nature. Because you can't compare the S&P with, for example, the Nasdaq, which only has tech stocks. So one important thing is to highlight the importance of how the S&P itself has in terms of the investment performance.
Exactly. So technically, what happens with investing in the S&P 500, you realize that instead of spending so much energy looking for individual stock selections to build up a portfolio, you realize that the returns from the S&P 500 tend to outperform most market or money managers. So if you go to a fund management firm and then you invest, and the fund management firm does its research, identifies individual stocks in the S&P 500, there's a very good chance that the person who bought the S&P 500 will beat that money manager. So it's a lazy way of investing where you don't have to do too much work. Just keep on building your bank and then let the market do its thing. But then, on the other hand, if you're very good at investing, then you also have a good chance of making good investment with alpha, or basically one portfolio that is performing better than the S&P 500. So the most difficult thing is basically beating the S&P 500 over a long period of time, because in some years you might be on the negative side, some years on the positive, but the S&P 500 tends to perform better than most managers. So whatever we are looking at here is basically the performance of the stock market as per today. So as you can see, some stocks have done badly, such as Amazon, which is down 3.89%. Facebook has a big hit after missing earnings. It's down 22.05%. Apple down 2.75%. Microsoft 2.02%, and so on. So you're able to tweak the period at which you observe the index. So for instance, if you look at the year-to-date performance, this is the performance of these stocks since the beginning of the year. That is 1st January. Then you can get an overall view of how the S&P has performed. Here you can see Microsoft is down 31%, Google 34%, Amazon 30%, and so on. While some other companies are in the green, like a Lillian company up 29%, ExxonMobil up 75%, Chevron up 50%. While some other companies have really outperformed the markets, like Occidental Petroleum, which is up 150%. So from here, you can literally tell the direction that the stock market has been taking, and clearly you can tell most of these companies have been on the negative side. So they have underperformed the market. So sometimes instead of focusing on the individual stocks, some investors will just focus on the S&P 500 individually. So if you look at the performance of the S&P 500 today, it's up slightly by 0.084%. But then, if you look at the year-to-date performance, it has been relatively going down, and this is a drop of about 20.07%. So generally, when you're talking about investing in stocks, if your portfolio is down lower than 20.07%, then we can generally say that the S&P 500 has outperformed your stock portfolio. However, if yours is higher, that is, let's say, to the positive side or negative 10%, then you've generally outperformed the S&P 500. So that being mentioned, how do you trade the S&P 500 on the MetaTrader 4 and MetaTrader 5 trading applications? So let's do a sample trade here. So this is the S&P 500, this is the 4-hour chart. As you can see, this is how it has been performing. So the most recent pattern we have seen on the 4-hour chart is basically an inverted head and shoulder pattern. So you can already see this, the market forming the first shoulder, then the head all the way down. And then we had the other shoulder here. Then from here, you can see the market pulled back, completed the pattern, broke the neckline towards the upper side, and it seems like we have some bullish momentum happening. Basically, a reversal of the prior trend, where generally the market was going down, and then after forming this pattern, there is the potential that the market could go down.
So just a comment.
Yes.
So because the S&P is so diversified, it means it is the best representative of the US economy. Yeah.
Yes.
That means if we have S&P having a bearish trend, that means the US economy is not doing quite well. And if you have a bullish trend, that means the US economy looks like it's improving. Yeah.
Yes.
So we have two ways to sort of try and map out the S&P index. In this case, we have the fundamentals and we have the technicals. So the fundamentals involves the reasoning behind these moves, the reasoning behind the state of the US economy. And then we have the technicals, which is how are these patterns forming out in the chart, which is what you're trying to elaborate. Yeah. And
yes,
bearing in mind those two reasons, we can simplify, for example, technical analysis, which involves patterns, is a very popular method when it comes to identifying entry points in the S&P, and which is what you're trying to specify in this segment.
Definitely. So in simple terms, a bet on the S&P is basically a bet on the US economy. So if you are deciding to invest in the S&P, or if you're tracking the S&P 500, then you're basically placing your bet on the performance of the US economy. So whenever the S&P 500 is going up, it basically implies that the US economy is doing well. And if economy is going down, then generally you will observe that the S&P 500 is going down. So the next part of today's presentation, I'm going to be moving this to sum. And this is regarding the factors that influence the demand and supply of the S&P 500, or the fundamental factors that influence the movement of the S&P 500. So Sam, what do you think moves the S&P 500, and what should investors be focusing in before making their projections in the market?
So before the first one, I'd like to focus on the technicals, because you have technicals and fundamentals as you've specified. So I'd like you to change to the daily chart, if you can, from your end.
Yes, I have these right here.
Exactly. And then zoom out a bit. So in this case, we can see a very clear trend. We can see that the S&P has been on an uptrend from 2020, exactly, from there, February. And then what happened was that from the beginning of the year, we had a downtrend, yeah? So we can have reasons to explain what created the uptrend. In this case, we had a case of quantitative easing. And then from that, when when everyone was expecting the Federal Reserve to start tightening the economy, in that they are trying to make economic conditions a bit tough so that the inflation is catered for, we had a downtrend. Yeah. So in this case, you can sort of join technical analysis to fundamental analysis, in that you're trying to have an explanation for these moves. So in this case, we had a very major, the most recent move we had was an uptrend in the markets. So now you're trying to, the major factor when it comes to investors is the perception of what the Federal Reserve is attempting or trying to do. And in this case, investors have become, I'd say, more resilient or more immune to what the Fed is doing, and everyone is sort of in a risk-on mode. And that's why you've seen from October that the news about increasing interest rates has been having less of an impact in the markets. That's why you've had a bullish trend, because investors are trying to anticipate the bottom of this bullish trend, bearish trend, because most of the times bearish reversals don't really last that much in the market. So in this case, we have investors who are trying to anticipate resilience in the market, and that's why you've had a bullish trend for the past, I think, 1 month and a half, if I'm not wrong. So one of the things when it comes to analysis is trying to place a reason to the price movements you're seeing in the charts, and it can be very tricky or very interesting if you're a fundamental trader or if you're a technical trader, because now at this point you have to know what is the sentiment in the market, what is the mood of the market, and how do you identify the mood of the market. Do you look at the trend? Do you look at news? Do you look at what is happening currently with the other economies in the globe? And in this case, we see that investors are trying to bet that the Federal Reserve is not going to raise interest rates as aggressively as they have been doing. And that's why you've had these bullish trends. So as a trader, you're trying to adjust price movements to the reasoning behind the price movement so that you can explain what's going to happen next.
Awesome. So when it comes to the S&P 500, as Sam has already mentioned, there's a couple of things that you can associate with the influence of the movement of price. So one of them, as already mentioned, if I zoom out again, is that since this crash here, this was a crash in March 2020, the Federal Reserve Bank of the US engaged in a massive printing program, and also they lowered interest rates, which made capital very affordable. And this drove a very strong recovery in the markets, as companies could find cheap financing, and also investors would have cheap financing to basically invest that money in the markets. So they pushed a lot of money in the markets, which drove the bull run for around 2 years. So towards the end of 2021, the Fed started changing tactic. In this case, they reduced the amount of money they were pumping into the markets to zero. It was a gradual reduction up to zero. And then immediately they reduced the quantitative easing program to zero. they started hiking interest rates in March. So from March, you can see that in February, prices were going up. Then at the beginning of the March, the markets started pushing further down. So this was a confirmation that we're in a bear market. You could see the market was forming lower highs and also lower lows. So since then, the Federal Reserve Bank of the US has been raising interest rates. And with higher interest rates comes a higher cost of financing. So getting loans gets more expensive and people are discouraged from investing. So at the same time, if you look at the inflation that we experienced as a result of more money being inputted into the system, these led to high inflation. So as we are approaching the end of 2021, the inflation data started reading higher than normal, went to 3%, 4, 5, 6. And by the time we were getting to June, July, the market had seen an inflation rate of 9.1% in the US. So the Fed got very aggressive in raising interest rates, and this drove the markets lower, and inflation is beginning to take the proper direction. So from 9.1%, we saw 8.9%, then 8.5%, and in the most recent reading, the inflation rate was 8.2%. So make no mistake, this is still a very high inflation rate. Basically, the Fed's target is around 2%. So with inflation rate reading at 8.2%, then the Fed has a mandate to make sure that it goes back down. Remember, all central banks have a very simple mandate. One is to stabilize prices. The other one to ensure full employment in the economy, to ensure economic growth. And yes, the economy of the US is growing well. Jobs are not that badly off. 2 months ago, the employment data indicated that the US was at full employment, but inflation is a big issue and it remains the #1 priority for the Fed. So with the Fed looking to hike interest rates, this has strengthened the dollar, but on the other hand, weakened the stock market. So when it comes to the information that you look for when investing or trading the US 500 or the S&P 500, one is economic data. You want to know the direction that the Fed is taking in terms of economic policy. Interest rates is a major factor. Quantitative easing is also another major factor. So inflation data is also very important. You want to know whether there is high inflation or low inflation. You also need to know the purchasing power of the American consumer. So if the American consumer has more purchasing power, then they buy more products. These companies make more sales, more revenues, and in return, they perform better and the stock prices go up, leading to the S&P 500 moving up higher. So the most recent data that we have in the market right now is that companies are announcing their earnings reports. So the most recent one was Facebook with a big miss. Google also experiencing some challenges, though quite resilient. But at the same time, early in the day today, we saw US economic data. So I can go to the economic calendar right away and show you how this happened. So I'm going to use the Forex Factory website. Seems to be quite stable for me. So just go to the calendar here. And then you look at the most recent data that was released today. And this was the advanced GDP quarter over quarter. This is the gross domestic product. So we all know that all the companies operating in the US, whenever they create value and make sales, then this contributes to the GDP of the US. So if you're betting in the S&P 500 and at the same time you're betting in the performance of the US economy, then the GDP is a good measure. So in the previous reading, as you can see, there was a contraction of negative 0.6%, but this time we expected a rise of 2.3%, but the actual reading was a rise of 2.6%. So this was big. It was a big factor in the markets. So you can see majority of the time, the last couple of years, the GDP has been on the positive side and very small number of quarters that the GDP was on the negative side. So we saw negative GDP happening around 2008, 2009. That was during the global financial markets crisis. Then during the beginning of COVID, March and April, during the lockdowns, these caused out of negative performance in the GDP. Immediately the market recovered as a result of low interest rates and high stimulus packages. So since then, you can easily identify how the GDP has been performing in the US. So in the most recent months, you can see that the GDP has been relatively high before dropping to the negative side in April, and then another negative in July, and now in the most recent reading today, the GDP has bumped towards the upper side. So two negative consecutive quarters basically imply a recession. So that's why we say that in March, April 2020, the US economy was in a recession. So whenever you see something like that happening, for instance, if you go back to 2007 to 2008, you'd notice there was a number of quarters where the market was consecutively on the negative side, indicating a recession. So right now, the market has changed direction and moved to the upper side, and investors have the sentiment that the recession may have come to an end, and they are very positive about equities. So this may explain the positive performance of the S&P 500 earlier today. So with that in mind, if you look at the S&P 500 chart here and look at how it has been performing since last week or the prior week, then this was basically a setup for a reversal. And now it seems like the market is headed for a bull run towards the upper side. So the other key thing to notice is that there could be some politics involved. So whenever you are doing your fundamental analysis, don't ignore the geopolitical sector. So in this case, the US is headed for an election on 8th of next month. And this could cause some bullish optimism, hoping that the presidency will implement policies that are supportive of the stock market, not in the elections. So looking at the S&P 500 and how it's performing, it's quite clear that this market is on a bull run that is not quite convincing because we are still within the bearish channel. So you can see the high here followed by the high here followed by the high here forms a very nice trend line indicating that we are still in a bear market. So despite the bullish momentum we are seeing here, this could be only a relief rally that runs for a short period of time, and then the market continues along the bear market. So my projection for this one is that potentially we'll see the market moving up higher. Once it gets to the upper trend line, then perhaps we'll see the market continuing to move back downwards. So why am I saying this? One is that the economic challenges that the US is facing have not suddenly come to an end. They are still very present. So inflation is still very high at 8.2%, and this is affecting consumer purchasing power. So whenever there is a high inflation, people are spending more of their income in paying their energy bills, their food bills, transport, housing, and so on. So they are left with less money to buy other products and also to invest. So with the economy running on less money and the Federal Reserve Bank continuing with its policy of tightening, then this bull run is not very convincing. It might run for the next week, but eventually once we get to the resistance level, there's a good chance that the market will come tumbling back down. So a level of around 4,100 per share might be the resistance. And once we get to this, then there's a potential that the market will pull back down. So here's what we know about the S&P 500. One, the earnings have not been very convincing. A lot of companies have been facing challenges over the last quarter. Apple is hiking prices. Facebook is spending so much money in the metaverse project. They are losing revenue. Google is missing earnings. Tesla is basically cutting prices for their products in China. There's geopolitical tensions and war between, that is economic war between US and China. Most recently, the companies producing microchips in the US were banned from selling their products in Russia. They're also banned from selling the same products in China, meaning that their revenues will take a big hit. So for companies such as NVIDIA and others in the microchip industry, they'll be taking a big hit. And once this is reflected in their earnings reports, then investors will come back to reality. And eventually, I expect the stock market to continue towards the downward side. So the other key thing is that investors will tend to front-run the Fed or the Federal Reserve Bank of the US. So whenever the Fed is looking to make decisions, investors will look at the data points and try to front-run it. So in the most recent meetings, they were doing 75 basis points hike. So in this particular meeting, we could see another hike not 75, but potentially 50 basis points. So the overall expectation from major economies market, we are seeing 75 basis points. But if the Fed decides to do a 50 basis points, like the Bank of Canada did yesterday, then we could see some potential confidence in the market driving a small rally towards the resistance level here. So potentially, we are looking at a meeting happening next week. I think it's second or third. And once it happens, then we could see a potential rally towards this area here, 100. And once the market realizes that we are still in a bear market, then we could see the prices pushing back down. So that's my projection for the quarter. So key data to watch is the Fed meeting next week, the outcome of the elections, that is the US midterms, that would be 2 weeks from now. So the midterms are very important because the Democrats are looking to win, and at the same time, the Republicans are also doing a very strong campaign. So the Republicans are majorly against the support for Ukraine. So the amount of money that Biden has been pumping into Ukraine would be reduced, and we could see some changes in the geopolitical sector, especially in the war between Russia and Ukraine. So that's one key thing to put in the numbers here. So the other key data to watch is oil. Remember that economies are driven by energy, and one of the major energies that the US consumes is oil. So over the last couple of months, since March, the president of the US created a program, draw more oil from the strategic oil reserves. So he has been doing these every week since March up to today, and these have driven the strategic oil reserves way down. And now, if you look at diesel, they have around 2 months remaining of supply. And if this runs out, they will be forced to buy from the open market. So the same case, petrol, they don't have as much petrol in their reserves. So within 1 or 2 months down the line, they will be forced to buy back oil from the markets. So from the most recent speech by the Saudi Arabia Minister of Energy, he mentioned that these economies have been manipulating the oil prices, and restocking those reserves might be very expensive. So from the most recent meeting by OPEC, they decided to cut oil production by 2 million barrels per day. So by doing this, they basically reduce the oil output, putting upside pressure on oil prices. So if oil prices significantly move higher, these would be very negative for the S&P 500. So that's a key data to watch, especially considering that the OPEC plus countries might be meeting soon. And once they do, and they decide to cut oil production further, then this would be a big factor to consider, especially if you are trading the S&P 500. So for most of the people who have been following these sessions, they understand the movements here, and they know the critical trading points to watch, especially when the market is on a bull run. So we experienced these a couple of weeks ago, and once we got to this point, we called it easily, and it was an easy ride downwards. So now that the market is moving up, the projection is that the market will continue moving higher. But once we get to the resistance, there's a good chance we might be going back down, and this could be real quick. So that's my view on that. So hopefully this brings you value. And at the same time, I'll be looking at more questions that you guys have raised and try to respond to them. So there's a good question here. Rufas, what time frame are you seeing that pattern? That was the 4-hour chart. So is the market open 24 hours? Hello, Sam?
I think we can go to the charts and try and see from the technical perspective what the fundamentals are printing out in terms of charts.
That is from the stats.
From the technical perspective. So if we were to go back to the charts themselves and try to see exactly. So in this case, if we were to go to the, for example, H4 time frame, we see that from August, the market has been on this downtrend structure, printing lower lows and lower highs. Yeah. So from the month of August, we've been having this structure where we've been printing lower lows and lower highs. Yeah. And that's from what you've actually explained. The market is afraid of increased interest rates from the Fed. And that's been straining the economy, and the investors have perceived that as negative, having negative consequences to the economy. Yeah. But something very interesting has happened. Despite the market expecting more aggressive hikes, we've had a higher print. We've had the market breaking a previous lower high. So I don't know if you can mark that, Rufus.
Breaking a previous lower high. Yes, yeah. I'm seeing these, just highlighted these. So in this case, you have that, and also the high here.
Exactly, over there. Yeah. So the market has broken a previous lower high. So in this case, as a technical trader, it should give you some insight as to what investors are thinking. Are investors more resilient to what the Fed rate hikes? Maybe investors don't really seem to perceive the rate hikes as having a bad impact to the economy, and that's why maybe you had that increase in stock prices. That could be a reason. And then if you are to go to a lower time frame, then as a technical trader, as an intraday trader, then you need to understand what exactly is happening in the markets. In this case, we've had a push higher from 25th October. We've had a push higher. Go to the most recent segment. We've had a push higher for stocks. And ideally, in a normal market, we're supposed to retrace. We're supposed to have a deep retracement in prices. Yeah. But exactly, exactly. So we're supposed to have a deep retracement in prices because probably it was profit taking from short sellers or people exiting their positions. But in this case, the market is refusing to go lower. As you can see that the market is forming a support line, I think above 3,800. Yeah. So one of the things with technical analysis is you're trying to build a narrative from what you're seeing on the charts, trying to build a perspective of which you're going to put your money on the line for that perspective. In this case, price is failing to form lower prints in the chart. So you have that upwards push, you're forming a higher high, but then the market isn't really forming a lower low. And that tells you something about investors. Are investors beginning to bet that despite the Fed hike interest rates, you're not seeing, you're still in a risk on mode? That's something you can probably research on. And in this case, we are seeing that the market has printed a higher high, and the investors are failing to check this prices lower. So does that tell you something about the resilience of investors in the market? Yeah, and the sentiment of traders in the market. So in this case, then as a trader, you should be able to assess this and see what is the best course of action. What are you going to look for in this market? Which side are you going to align with so that you get the best results? Because in this case, in a normal market, this market should have retraced quite some time back. In my opinion, that is, Rufus. This market should have retraced very early because we've had that push and we know the Fed is going to hike more aggressively. But despite that, we have investors coming into the market, and these prices are failing to print lower lows. So what does that tell you about investors? What does that tell you about the mood of the market? Maybe Rufus, you can expound on that.
Thank you, Sam. So from what I'm seeing here, I think the technical pattern was a big part of the move here. So whenever you're focusing on technicals, they become more or less like a self-fulfilling prophecy. As a result, of many traders observing the same pattern and acting in a similar manner. So there's a lot of traders who are observing this particular pattern here. And every time an inverted head and shoulder happens in such a market, such as this one, then you expect some reversal here. So a lot of traders are betting on this particular pattern. And at the same time, when you look at the fundamentals, there is a good chance that the economy of the US is showing some strength. And at the same time, we are seeing an inversion happening right now, where the dollar has taken a step back. So part of the reason why, as to why the S&P 500 has been going down, is as a result of the strong dollar. So remember, all these stocks are priced in dollars. So if the dollar is very strong, then you realize that the opposite or the reverse goes down. So we have been experiencing an inverse relationship between the dollar and the S&P 500 stocks. So as the dollar index keeps on rising, then we have been seeing the S&P 500 go down. So from here, if I take you to the dollar index, you'll notice that in the last 2 weeks, since Friday last week, we have seen the dollar drop sharply from this high all the way down to 109 before resuming back to 110. So these might have an impact in the S&P 500. So there's a good question I'm seeing right now, and this is regarding the correlation between the S&P 500 and the Dow Jones as well as the US Tech 100. So let me try and check on this real quick. So just one moment. So looking at is that. So here's the Dow Jones. It's basically written as the US 30. So what we are seeing here is a double bottom pattern on the 4-hour chart. So this double bottom pattern is also a reversal pattern that was completed about 2 weeks ago. Since then, the market went up, retested the area before rallying all the way up. So as you can see, the rally has moved significantly higher, targeting the previous high around 32,615, and it seems very strong moving towards that particular point. So we know that the US 30 can be considered as the old Wall Street. It basically represents some of the most stable companies in the US, or sometimes described as the industrial sector. So in this case, there's a strong momentum here happening since the end of last week, that was Friday, all the way to the current price level here. And this is indicative that there is a renewed confidence in the markets. And this is with the expectation that the Federal Reserve Bank of the US might go slow on the interest rate hikes. So the previous hikes of 75 basis points, which happened 3 consecutive times, are really hurting the global economy, and pressure may have hit the Fed. And in this case, it might slow down, and this could be representative of investors betting on that information. So yes, the correlations are there, but not very straightforward, not very strong. So when you look at the US Tech 100, it's the same thing as the US 500, only that this one seems to be a little bit less aggressive. So there was an inverted head and shoulder pattern forming, very similar to the S&P 500. But judging from what we are seeing with the price happening here, and this is between today and yesterday, the US Tech 100 or the NASDAQ has taken a big hit as a result of the big tech companies missing their earnings. So when Facebook dropped over 22% within a day, that was last night, then this led to the massive sell-off in the NASDAQ. So if you go back to the same chart that we had right here, then you notice the same information. So Facebook is a big part of the US Tech 100. And as you can see, Meta Capital here, or Meta Platforms, it's down 61% year to date. But then if you look at the just 24-hour performance, then Meta is down 22.89%. So when you think of the NASDAQ as an index that has a lot of tech companies controlling its direction, then if you take the big companies here, Amazon, you look at Google, Meta, Apple, Microsoft, and these are the behemoths in the tech sector, if they're all going down, then it explains why the Nasdaq is basically going down, while all these other markets are seemingly moving towards the upper direction. So
Exactly.
you go back here. Yes, Sam.
Yeah, I think one thing you've put out clearly is we have
Yes.
3 indices. One is the Dow Jones, which is
Yes.
the US 30. We have the Nasdaq.
Yes.
We have the
Yes.
S&P. So the Dow Jones is comprised of very established companies, while the Nasdaq is comprised of tech stocks, companies that have a huge potential going forward, while the S&P is more of a balance between the two, the Nasdaq and the Dow Jones. So in this case,
the S&P is the overall market.
Exactly. It gives a balance between the two. So when we have a lot of uncertainty, then investors tend to fall to what they believe is a sure bet, what they believe is more stable income streams, and that's why the Dow Jones has had a really very tremendous rally for the past 2 months, 1 month, yeah. And the Nasdaq hasn't had quite as much of a good uptrend as compared to the Dow Jones, yeah. And when it comes to periods of risk on sentiment, where you have everyone trying to take risks, then you have the Nasdaq outperforming both the S&P and the Nasdaq, and the Dow Jones. So in this case, we have the Dow Jones outperforming both the S&P, which is a balance between the Nasdaq and the Dow Jones, and outperforming the S&P. So in this case, we have the Dow Jones really rocketing higher than the other 2 indices, just by the mere fact that it's made up of stable companies. And
Yes,
that's why you have this. Exactly.
Just to supplement what you're saying, if you look at the companies in the Dow Jones, you notice that they are very established companies which have been in the market for a long time. They have pricing power, and somehow they're able to beat inflation, though not all of them. So for instance, if you look at companies like Chevron in the energy sector, it has a big ranking in the Dow Jones. It's a big company, has been doing well. It's in the energy sector. You can see it's up a good %. So if you look at others, look at American Express, very resilient, AMGen, Apple, Boeing, Caterpillar, Cisco Systems, Chevron, Goldman Sachs, Home Depot, Honeywell, International Business Machines, or IBM. So Coca-Cola, a very stable company, Johnson & Johnson. So these are companies that are very resilient, and they're able to manage their business well. They have a huge moat, or basically they command a big market share. So even when things are bad, investors are much more comfortable holding on to these stocks compared to some tech stocks like NVIDIA or Facebook that can take a big hit of 22% in a day. And these are as a result of missing earnings expectations. So in this case, investors are more comfortable investing in these solid companies compared to going for growth stocks. So technically, when things are doing well, people will invest more in the growth stocks, and the Nasdaq will generally outperform the S&P 500 as well as the Dow Jones. When things are doing badly, the Nasdaq will be leading, moving downwards, but the Dow Jones will be more resilient, while the S&P 500 will be somewhere on the midpoint. So I think you have a very strong case here.
Yeah, exactly. So if someone was to compare, at the moment we have a period of a lot of uncertainty. We have the Fed raising interest rates. We have the economic data coming in, and we have a high inflation print and everything. And one of the indices that's really doing or outperforming the rest of the indices is the Dow Jones. Exactly. So in this case, most of the investors are trying to pile up or position themselves in a situation where, in the event the Dow Jones prints higher prices, then they are able to gain from that movement. So in this case, a lot of investors are going for safety, and despite going to different asset classes, the Dow Jones, which comprises of very stable companies, is an option for most investors. That's why you have this very obvious up push from the Dow Jones, unlike the S&P, unlike the Nasdaq, which are struggling in some sense, although they're very correlated to the Dow Jones, in my opinion.
Awesome. So now, as we approach the end of the presentation tonight, I would like to check on a couple of questions that have been raised from the comment section. So one of the questions that I haven't addressed yet is that, is the market open for 24 hours? So I would like to give a very proactive response to this. So different assets have different trading periods. And the way you do this is by observing each asset individually, or each asset class as an individual asset. So from this particular section of the Market Watch, if you look at, let's say, the US 500, you can click on that asset and then select specification. So from here, the pop-up window, you get this description of the asset, right from the contract size, the number of digits on the assets, and so on. But if you scroll to the bottom, you'll get the quotes or the sessions, quotes, and trading. So for the S&P 500, it's tradable from Monday at 1 a.m., that is 1 hour past midnight, through to midnight. Then it keeps on trading continuously. Remember, there's a 1 hour break between midnight and 1. So once the market closes at midnight, it opens an hour later, and then keeps on trading for 23 hours a day up until Friday midnight. So that's how we check on the sessions. And of course, different assets will have different trading periods, which you can always check and verify on the MetaTrader 5 trading application. So on the next question, let me check quickly. Reading the economic calendar, after how long are figures updated? Say the release is to come at 6. Do you expect the reading to reflect at 6 sharp? Yes. So when it comes to reading the economic calendar and you're expecting some data, you expect the data to be announced immediately. So let me show you how it happens. So the Forex Factory website and most of these economic calendars, they are data aggregators. They'll find data from different websites and then combine these data into one website. So for instance, if you go to, let's look at the most recent data. So the most recent data in the market was natural gas storage in the US. And this data was released at 5:30 p.m. So if you click on this, you realize that this data has a source, and it comes from the Energy Information Administration in the US. So there's a website called EIA.gov, and it's the one that releases the news. So everyone has access to this information. So what this website does, to track this information and then publish it here. So it might take longer, maybe a minute, sometimes a second, sometimes it's instant. So if you want to get data as fast as possible, then you get the data from the source. You don't have to depend on the calendar. If you're waiting for this information, just click on the source and then track the data from the source. So this way, you'll get the data in real time, immediately as it is released. So that's how you go about it. So
yeah, just to add.
Yes.
Just to add on to that, Rufas, when it comes to fundamental analysis, the first thing you need to conduct is a sensitivity analysis. How important is that news going to affect the market? If you're to go back to Forex Factory, let's go back to Forex Factory.
Right away.
The first thing a trader needs to do is to conduct a short research on how important that data, that piece of information is to the market. So in this case, for example, we have the main referencing rate from the ECB. You need to go and see maybe 2 data points back. How did that impact the market when it was released? Because at some point, an investor needs to know. For example, in this year, 2022, we have inflation data being more important than employment data. which has never been the case for most of us who started trading from around 2015. So you need to know the impact of this data point to the market, on the market. Is the market really focusing on this point? Yes, you might have the column for impact being red, but is this really important to market participants? Is this really important to buyers and sellers? And that's why you need to expound on the data, see when the previous announcements were made, and research how that announcement impacted the market on that date. On MT4 for FXpress, you can rewind the markets and see exactly when that announcement was made, how the market reacted. And that's how you're able to get the optimal entries. Those they're called sniper entries from the market. Because at some point, some of this information, you might think that they're in red, but in actual sense, when they're released, the market doesn't really, prices don't really move. Prices don't really change based off of that market. So you need to see the first thing as a fundamental, when you're doing fundamental trading, is to understand how the impact of this piece of information is going to affect the market. And that's why in Forex Factory, which is a very good calendar, you can assess the history of the previous announcements. 2, 3, 4 recordings back can give you enough information as to whether this news piece is really impacting the market or not. And that's your starting point as an analyst in the market.
Exactly. So in the last question here, we also have Russell 2000. He's also doing so well, a USA index. Yes. So we have a lot of stock market indices in the US. We've just mentioned the top 3. So we have the Russell 2000, which basically tracks the top 1,000 companies micro cap in the US. So when you're looking at smaller companies and how they are performing, you don't have to buy their stocks individually. You can buy the Russell 2000 and it will give you a much wider exposure to the smaller companies within the US. So far it's doing well, indicating that smaller businesses are doing well compared to bigger businesses. And it might be something you might consider doing your research. And if it indicates an opportunity, then also invest in. So sorry, I missed the beginning. Did we discuss the dollar? Definitely. The recording is available on YouTube. You can always go back and check on the same webinar, go through it again if you need to grab some points that you missed. So
I think
this marks yes.
Rufas, you can open Well Wisdom. Just search Well Wisdom on your Chrome.
You said when?
Well, the fish, the big fish. well, WH. Let's see. WHAL.
Like that.
Well Wisdom. WHALE. See. Yeah, wisdom.
Yeah. Got it.
Exactly. So one important thing when it comes to diversification and investing in stocks, you can try and follow what the big boys are doing, which is a very easy way to see what stocks you should be in the long term. Of course, we offer all the stocks, but it's good to know what other big players are doing. And in this case, Well Wisdom gives you a very good breakdown of what stocks the big hedge.
I think we lost you some. All right. So as we wait for Sam to join back, so we have Russell 2000. It's doing well. You might want to consider that. So I would like to take this moment to thank everyone for taking the time for joining in. I hope the presentation provided value to you guys. I hope you're able to narrow down these opportunities, understand the technical as well as the fundamentals bit of trading the S&P 500 and use this information to your advantage. So enjoy the rest of your night. I hope to see you guys on the next session.